All right, so a very good evening. I'm just going to give the other attendees a couple of seconds to enter the room. All right, excellent. All right, so yes, good evening. Today's webinar will be on, as you can see here, how to trade the euro dollar like a pro. My name's Aaron Hill, and I'm very pleased to have you here today. So, over the next hour, the idea is to deep dive into the euro dollar. This is the world's most liquid currency pair, the most actively traded currency pair, and it's the euro dollar versus the euro versus the US dollar. Now, look, whether you're completely new to FX or you've been trading for a few years, today's session will hopefully give you some actionable insights that you can apply immediately. My aim, as always, with these presentations is to deliver a presentation that I would have wanted to see in my early days. Feel free to use the chat box, guys. If you have any questions, I'll try and get through them as we progress. But if you prefer, you can wait till the end where we essentially open the floor to questions. This session is being recorded and will be available to all attendees. And look, guys, this is quite a disclaimer. I'm certainly not going to read through all of this, but suffice it to say that this presentation is essentially educational advice only. It does not constitute any form of investment advice. All right, so here's what I plan to cover today. So we're going to understand what the world's most traded currency pair is, and also what moves this currency pair, so the euro dollar. Second, the aim is to get a little bit more tactical in the sense that, just bear with me a minute, in the sense that we'll be looking for some high probability trading opportunities using a combination of techniques that I've used for years. And look, they've never failed me yet. And I know of a number of traders that use these as well. And they're very simple. Once you really understand how the macro and the technical side work together. I primarily was a technical analyst in my early days, and that's what my mentor taught me. And look, if you're a steadfast technical analyst, that's fine. You can still make money with this, but I've found over the years with combining macro and technical really is far more superior. It certainly has turned out to be that way for me. Then we'll discuss on what it takes to attain a winning trading mindset. So this is something that's overlooked, something that's often overlooked, but absolutely crucial. The winning trading mindset, and this is something I ignored in my early days because I believed that analysis was the key, right? If you can analyze a chart, if you can pick your entries, you can pick your exits, that will take everything else will take care of itself. How wrong I was. You can have the best trading strategy in the world, but without the right psychological foundation, you'll struggle to execute consistently, I've found. And finally, as you can see here, we'll open the floor to a live Q&A session, and this is your chance to really ask any questions that any and get specific answers to your trading challenges. So let's get this underway. What is a euro dollar? I apologize if comes across as basic, but we have to start from the very basics here. So what is the euro dollar? So the euro dollar represents the exchange rate between the euro and the US dollar. It indicates how many dollars are needed to buy 1 euro. The euro This currency pair serves as really a primary benchmark for the strength of the European economy against the US economy. Note that the price of the euro dollar is always quoted in dollars. So when you're looking at the euro dollar currency pair, you're going to see all the price changes will be in US dollars. So this takes me on to the next currency, the next slide, which should help explain this a lot more. So a currency pair is made up of base and quote currencies. Now, there are a number of different terms for the base and quote currencies. I mean, quote currencies can be referred to as a term currency and things like that. But commonly among retail traders, base and quote currencies are often used. So we have the base currency, which is the euro in this case, and the quote currency, which is the US dollar in this case. So the euro, um, as I said, the euro is often referred to as the base currency, and that always represents one unit of currency. So this would always be one or 100,000 or 10,000 or 1,000, depending on how many lots you're trading. The US dollar, as you can see here, the quote currency or the counter currency, it can be called as well. And this tells you how many dollars are needed by 1 euro, as I've already said. So forget this, but if the euro dollar exchange rate is 110, that means it takes $1.10 to buy 1 euro. Very basic, guys, I know, but that's the basic structure or the basic structure of the euro dollar. So that you're trading one currency against another. So when you buy the euro, you're actually selling the dollar. When you buy the dollar, you're actually selling the euro. Now, why? Oh, sorry, guys, I shouldn't have changed the. So my what why is the euro dollar the most widely traded currency? Let me just share my screen here because this is an incredibly important document and one I would highly recommend reading. This is the Bank for International Settlements, the OTC foreign exchange turnover. It's a big document, but now with AI, you can summarize everything. So do look into this. So why is the euro dollar the most widely traded currency pair? I mean, if you look at the document here, um, you can see that the euro dollar currency pair, the US dollar against the euro, traded as of April 2025 has a daily turnover of around $2 trillion per day, and that's in April 2025. So this represents 21.2 or 21% rounded of total global foreign exchange turnover. And as I said, this makes the euro, as you can see with the list here, this makes the euro dollar the most traded currency pair in the world. Now, for some context here, guys, this is up from 1.7 trillion 3 years ago because this is a triennial release. So this is up from 1.7 trillion in 2022 there. It's some numbers. It really is. I mean, this pair has made the euro dollar has maintained its position as number one for as long as as long as I can remember. As you can see here, it's remained at the top. So the second most traded currency pair, of course, is the dollar yen, and as you can see, this trades at had a daily turnover, a global daily turnover of 1.4 trillion. This is rounded again, guys. 1.4 trillion of April 2025, and this is up from 1 trillion in 2022. Now, for individual currencies, the US dollar and the euro, as you can see here, I'll try and highlight that. So this is the OTC foreign exchange turnover by currency. Look, as you can see, the US dollar is on 89% of one side of every trade. So 89% of on one side of sorry guys, on one side of 89% of all transactions in the FX space. That's quite something. And the US dollar alone accounts for $8.56 trillion per day. That's just insane amounts of money being transacted. For the euro, as you can see, look, we're trading the two most widely traded currencies here. So the euro accounts for 29% of global turnover, and that's at 2.8. Again, I'm rounding there, guys. $2.8 trillion per day. This is up from $2.3 trillion 3 years earlier in 2022. So they really are. The euro and the US dollar are highly liquid. This means there's essentially enough willing buyers and sellers in the market that makes it very easy for us to trade. And it also offers a very tight spread. So between your bid and ask, so the buy price and the sell price, it really gives us a tight spread. And this means lower transactions for us traders. In terms of volatility, it moves enough to create opportunities, but isn't, wildly erratic like some of the exotic pairs. And this really makes it a sweet spot for many many new traders coming into the market. So look, one piece of advice I would give any new traders watching or aspiring traders watching is to focus on one or two currency pairs. Um, I would personally start with the euro and the US dollar because you have the Fed, you have the ECB. You can really deep dive into how they work. Then you can look at the technicals, and you'll be surprised at how many opportunities you do get just by trading one currency pair. Okay, so back to the slides there, guys. Just bear with me. Okay. All right, so what drives the currency pair? Now, there are a number of reasons why a pair moves, a currency pair moves, and understanding what moves the currency pairs are key to trading consistently, in my opinion. I will try to combine, so the following slides, I will try to combine these slides with the approach I take, as this should hopefully make more sense, as I use all of these techniques to generate trading ideas. So as you can see here, number one is interest rate differentials. These are essentially the central bank expectations. This is the key driver for currencies, the key driver for the euro, the key driver for the US dollar. Interest rate differentials. What are the ECB doing? Are they holding? Are they cutting? Are they hiking? Same for the Fed. We need to understand that. Then we'll look, it's all in the data. We'll look at the economic data. I focus on the big three. So I focus on growth, inflation, and jobs data. These are key, especially for new traders beginning. This is certainly something I'd recommend. Focus on growth, GDP. More importantly, especially for the US dollar, jobs and inflation. These are key. Incoming data can also really determine how policy expectations, it can really shape policy expectations for both central banks. So these are, as I said, these are key, guys. Intermarket analysis. Now, for anyone that's been in the market a little while, would have probably heard of this. So intermarket analysis, what's happening in equities? Are we risk on? Are we risk off? And then the next one is positioning. Guys, positioning has been a complete game changer for me. I never used to focus on positioning, but realizing where the squeeze is really can help understand when a currency. So if we have a number of traders long a currency, you know that you can see that they're overextended. If you get something going against that position, this can trigger a healthy unwind, and this is something you want to be part of. Finally, technicals, guys. I still am a very passionate technical analyst, and given the years of experience that I have with technicals, this really helped me finalize the my trading decision, because ultimately you do enter on the chart, you do exit on the chart. So technicals are key. So, but you don't need to be an advanced technician to make this work. You need to know key support and resistance levels. I use two, which I will go over shortly. But that's all I use. I don't use anything else. I don't use the RSI. I rarely use the RSI anymore, because you can, excuse me, when you understand price momentum, you can really see that on the candles itself. All right, so rate differentials. So, as I said, this is the number one driver. Central bank expectations. Look, with the euro dollar, we're dealing with the ECB and we're dealing with the Fed. When the Fed I'm just going to give you an example here. When the Fed raises rates relative to the ECB, the European Central Bank, the dollar will typically strengthen. This is a very basic here, guys. The dollar will typically strengthen as yield becomes more attractive on the US side of things, and the euro dollar should subsequently fall on the back of that. When the ECB is more hawkish than the Fed, the ECB should rise, all else being equal. So look, right now, I'm pretty sure you are looking at the news right now, but we're in a particularly interesting environment, because we have the Fed, which is expected to ease policy sometime this year. When is difficult to tell, because especially after yesterday's minutes, right? With some market FOMC participants stating that they may be open to a rate hike. So When is very difficult, but ultimately the markets are expecting the Fed to ease policy. And look, the ECB right now is firmly on hold. If you look at the interest rate, the central bank expectations for the ECB, they're expected to remain on hold for the entire year. Okay, so I just need to share my chart to show this because this is something I wanted to, and for some reason I can't find my chart. Just bear with me a minute, guys. I'm gonna have to, whoops, sorry about this. Oh, here we go. All right, so this is the chart of the US Treasury 2-year yield and the 2-year yield for the Eurozone. So you can see here, as I said, we're looking at 2-year yields here, so very short-term yields, and we have a clear divergence. So as you can see, the ECB are pretty much, if you look to the left here, we're at around 2%, and if you look at the deposit rate, we are at 2%. So interest rate expectations, look, we have been ultimately trending higher. But if you look at the other line here, we have been trending lower. This is the Fed. This is the US 2-year yield. So we do have a divergence here. Now, if we remove the EU yields and we overlay the euro dollar, I mean, look at the divergence now here. This is typical. So you'll see that the euro dollar in green typically moves inversely to the 2-year US Treasury yields because of the relationship between interest rates and capital flows. So capital tends to flow to higher yielding assets. So when the 2-year yield rises, but right now it's dropping. When the 2-year yield rises, the US dollar generally strengthens. But when the 2-year yield drops, the euro tends to rise and the US dollar tends to fall. As you can see, what's happening here. These are very uh, interest rates are very important to follow. But I mean, you can just see here the divergence between the two. I mean, you look at the yields; they bottom here. Let me just sort this out so it's a bit clearer. We have a divergence. So the US yields rally, the euro dollar falls. Yields rally, euro dollar falls. It's a very strong inverse correlation that you need to be aware of. All right, so bear with me. I'm sorry about flipping between slides and charts, but I really wanted to give a more of a in-depth. Now I've lost my slides. Oh, there we are. Okay. Um, all right. Okay, so economic data. This is where it really gets interesting. So first and foremost, we need to understand the central bank's bias. Are they hawkish? Are they dovish? So hawkish means that they're more supportive of raising rates. Dovish means they're more supportive of lowering rates, or or are they on hold? Are they happy with where their rates are? So this is very important to understand. Understand the central bank bias. Then we look to the economic data for the euro and the US dollar. So this is why I said start with one currency pair, because can you imagine if you have 10 different currency pairs? Sorry, 10, say 5 different currency pairs. You've got to really focus on maybe 3, 4, 5 different economies. And that's very difficult when you're trying to analyze all of the data as well. So start with one, get acquainted with that currency pair on an in-depth level, and then you can move on. This is how I did it, and it's really worked out well for me in that sense. So just bear with me here. All right, so not, as I said, I focus on growth, inflation, and labor trends. That's all I focus on roughly, but I do branch out and I do look at the ISM data and things like that, but it always comes back to those three. So what is the ISM data telling me about employment? Because in the ISM data, you know that they have employment sub-indexes that can really affect, influence how the markets feel about employment. So not all data are created equal. Just bear with me, guys. So typically for the US dollar, non-farm payrolls, I'm pretty sure most of us have heard of that. This is released on the first Friday of every month. CPI, Consumer Price Index, inflation. So with the US, we have CPI, PPI, so Consumer Price Index, um, Producer Price Index. This is the wholesale inflation. Then we have PCE. So this is more of a broader measure of inflation. So we have three reports we focus on. Actually, tomorrow is the PCE release for the US, and this is could potentially be market moving. So do be aware of that. Of course, then we have the FOMC meetings and the statements. Guys, one piece of advice I would give you for anyone following the euro dollar is focus on what the Fed members speak about. So they often hit the financial wires, read what they're saying, understand where the bias is. So if some of them are hawkish or the majority of them are hawkish, this can really push the US dollar higher. They can and do move markets. GDP releases. So the GDP in the US releases data every month in the form of advance, preliminary, and final estimates, but you should be looking at all of them. Right now, growth is doing very well in the US. Ultimately, it's at 4.4% as of Q3 25. We do have the first estimate for Q4 25 out tomorrow, another important release. Now, for the Eurozone, ECB monetary policy decisions, Eurozone CPI. German economic data is key, of course, because German is essentially the locomotive for the EU. PMIs, very important. So the S&P global PMIs, one way of trading those is looking for divergences between the French and the German data. I rarely trade the Eurozone release, but divergences between, excuse me, guys, but between the French and the German data and the UK data. So you can really get some good moves on euro pound on the back of any divergences you see there. One important thing I would say about economic data, and this is really key, is that the market doesn't just react to the number itself. It's sorry guys, it's more it reacts to the number versus expectations. So a good employment number that misses expectations can actually weaken a currency. I hope that makes sense. This is very important to remember if you trade news. You trade the outcome versus the expectation, not versus the prior data. This is very important if you're trading out of risk events, which is what I primarily look to do. How I use these data, how I use the growth, inflation, and jobs data is very, very simple. I first look at what the central bank, as I said, what is the central bank watching? Um, they tell you in their forward guidance, read their statements. They tell you, guys, you can use AI, you can summarize all of their documents. I know they're quite lengthy, but jump onto AI, summarize the documents, and see what they're looking at. And then you watch those data, you monitor the same data. So right now the Fed is focused. I mean, look, it's clear what the Fed is focused on. The Fed is focused on both inflation and jobs. Before it was just a jobs data. Now it's the risks between both are kind of balanced right now. So inflation and jobs. So I watch these events closely. I know when they're coming out, and I watch those events closely when they are released for potential trading opportunities. I will show you one on that occurred with the RBN Reserve Bank of New Zealand recently. It was an awesome opportunity to short the New Zealand dollar. It's not related to the euro dollar, but this is just a perfect example of what I mean. So we know the Fed is expected. I'm going back to this again. We know the Fed is expected to ease policy, uh, but is concerned about inflation and jobs. So what do you think? Here's a question for you guys. What do you think will happen tomorrow if to the US dollar if PC inflation jumps to 3%? Right now it's at 2.8%, and the market is expecting, I think it's expecting it to remain at 2.8%. Again, guys, the Fed tracks the PCE data. This is what they track for inflation. So what do you think will happen if inflation jumps to 3% when the central bank are concerned about inflation? So this should really underpin the US dollar. And of course, if you buy the US dollar, that weighs on the euro, so the euro dollar should fall. This should present a nice scalping opportunity for the euro dollar. What do you think will happen if US jobs comes in markedly softer in February? I mean, I'm pretty sure you saw the blowout report we had in January. Um, Look, if jobs data comes in markedly softer, as I said, the euro dollar should rally as traders price in a faster pace of easing for the Fed. So the euro dollar, so traders buy the euro, sell the dollar on the back of that faster pace of potential easing out of the Fed. For the ECB right now, as I've just mentioned, sorry, I haven't mentioned about the economic data, but I have mentioned that the ECB are on hold. Economic data is looking fine to me. We have unemployment at historic lows, growth is fine, inflation is around 2%. I mean, the concern right now for the from what I've read for the ECB, is that regarding the appreciation in the euro. So a strong euro exerts downward pressure on inflation. So they're more worried about inflation undershooting the 2% target. A strong euro means cheaper imports, as the euro now buys more dollars and things like that. So certainly something to be aware of. So it's key. Economic data is where you get that signal to trade. So a good way to think about this always is macro gives you the why, answers the question as to why the currency pair is moving in a certain direction. Your technicals give you that when to pull the trigger, and this will become very clear with an example I will show you shortly. Geopolitics and market sentiment. Look, the euro dollar is an incredibly politically sensitive currency pair. Um, Given it represents two of the largest economies, right? Two of the largest economies in the world. So I've always found geopolitics very, very difficult to trade. I mean, for one, it's unscheduled. So you could have a post from President Trump on his Truth Social platform can really change everything, and I just find that very difficult to trade. And yeah, so make of it as you make of it what you will with geopolitics, but I tend to try and stay away from that. You do need to be aware of it because it can really affect it can really affect things. So look, we have, as you can see on the slides there, haven flows. So the US dollar tends to benefit during global crises, right? So because it's one of the world's major reserve currencies, investors tend to flee to dollars when things get scary, if you will. So when geopolitical tensions rise, so think of wars, sanctions, diplomatic breakdowns, and things like that, euro dollar often falls as capital rushes into the US dollar. The euro, by contrast, is viewed as more of a risk-on currency, I would say, meaning that it tends to rally when things are doing better, when there's more optimism around. Europe's, as you can see here, geography. Europe's geographic position matters a lot. So the Russian-Ukraine war is a prime example. It hammered the euro. It absolutely hammered the euro because Europe faced direct energy disruption, refugee pressure, and military spending demands. So the closer a conflict is to the eurozone, the more the euro tends to suffer relative to the dollar. Sanctions is another thing, trade policy. I'm pretty sure I don't need to mention much about this. I'm sure we're all aware of what's going on with the US and trade wars and things like that. But US imposed sanctions or tariff regimes can shift trade flows significantly. I mean, if the US imposes tariffs on European goods, it weakens European export revenue, of course, and this can drag the euro down. Policy divergence. We just spoke about policy divergence, ECB and the Fed. But look, geopolitical shocks can often force central banks to react differently. If a conflict hurts, say, Europe more than the US, the ECB may cut rates while the Fed holds. And that interest rate differential tends to push the euro dollar lower since capital chases higher yields in dollars. Now, these are just a few examples. The bottom line is the US dollar generally acts as a geopolitical safe haven. So most global instability tends to push the euro dollar lower. European specific shocks amplify that move, while US specific political risks, so debt ceiling crisis, domestic instability can reverse it and push the euro dollar higher. Now, as you can see here, positioning is important. Now, this is something I really do want to touch on. Um, Now, we have the central bank's bias locked in. We know what the Fed's doing. We know what the ECB is doing. We should know that. That should be noted. We have a good handle on the economic data. We know what both central banks are watching. We know guys, it's all about the Fed, right? Sorry, it's all about the US economy right now. The euro, as I said, the Eurozone economy is doing okay in terms of the current economic data. The US dollar, the US, um, it's not doing bad, but it's in more of a, it's more of a tradable, it's offering more tradable scenarios. Let's put it that way. So, as I said, positioning is incredibly important in my trading as I essentially look to fade overstretched long and short positions from non-commercial traders. What do I mean by non-commercial traders? These are the large speculators. These are the big trend followers. Um, they're in the market for profit and are not looking to take delivery of the underlying assets. You see, with positioning, I tend to use the COT data, so the commitment of traders data. It's primarily futures data. So as I said, they're not looking to take delivery of the underlying asset. They are traders. Um, these can be hedge funds. These can be commodity trading advisors. For example, the smart money. We are looking to fade these positions. This is something I will touch on shortly. Look, I think it's best I explain this in a chart. So I do have a chart set up, ready to go. Bear with me. And there we go. So with my trading view package, I set up that there are a number of different mathematical ways you can look for overstress positioning in with the futures data. I just tend to use my technical background and find oversold and overbought areas. So this is the Euro futures, the CME from the CME. So I have a match. Look, it's pretty simple where to see overbought and oversold areas are. So right now, this is the COT data and this is the Euro futures. So would you say right now, just looking at this chart here, would you say, and these are the large speculators here, guys, would you say that they are overstretched to the upside or overstretched to the downside? Look, guys, for me, that they are overextended to the upside. So if now let's see where we are in terms. So we know the euro is overstretched to the upside. Now let's see where we are in terms of the US dollar. Pretty simple, guys. We are overstretched to the downside. We are starting to recover, but we are, look, it's pretty simple. We are overstretched to the downside here for the US dollar. So if we get data, if we get an upside surprise in US data, let's say jobs data once again surprises to the upside, or tomorrow's PCE inflation data jumps above 3% or something like that. What do you think will happen to the euro dollar pair considering this positioning? It should technically, if we get an upside surprise with the US data, it should technically create a strong bid in the US dollar, right? So one that one that we as traders want to be part of. But knowing that the euro is overstretched to the upside, and we know that the US dollar is stretched to the downside, this almost creates a 1-2 punch, right? So as when the US dollar is bid, we know, and we know that uh, um, we know on the back of that, so the euro we'll see short positions unwind on the US dollar, and we'll see euro positions unwind, euro long positions unwind. So this will create a strong unwinding opportunity. I do hope I haven't confused anyone here. It's pretty simple. So the euro is overextended to the upside, US dollar is overextended to the downside. If we get positive US data, there are a number of traders short this market right now. What do you think they're going to do when they or if they see US PCE data surprise to the upside? They're going to close those short positions, creating an upside, an unwind, which means long positions, right? And you want to be part of that. So you'll jump on the back of that as traders are unwinding those dollar short positions. And because we're trading against the euro here, and we are overextended to the upside here, this will also see euro long positions unwind as well. Close out the euro long positions, and this creates a short bias. So it should technically create a euro dollar shorting opportunity. Positioning is so important, guys. It really is. I can't emphasize that enough. All right. So timing is everything in FX. The euro dollar has three distinct trading personalities, if you will. We have the Asian session, that's Tokyo. It's generally pretty quiet for the euro dollar. Look for ranging price action in the Asian session. Um, I don't have the pips, the actual average range data with me, but I think it's around 40 pips maybe in the Asian session if you're lucky. Best for range traders in the Asian session. But the London session, this is where the euro dollar wakes up. You've often, I'm pretty sure you've seen it when London opens, when the cash market opens, so the FTSE and stuff like that open, you'll see liquidity injected into the market. European traders come online, volume increases dramatically. This session can really set the tone for the day. Then the New York session opens, and this is really peak liquidity, especially when London and New York are both open together. This is the London-New York overlap, which for me is between 2 p.m. London time and around 4:30 p.m. So around 2 p.m. is when I think it's 2 p.m. is when the US cash session opens, and this is when the overlap begins for me. This is prime time, guys. This is when major US economic data is usually released, or just before, and you get the most decisive directional moves. This is when volatility really does hit the markets and gives you pretty good opportunity to trade. Uh, as I said, excuse me, the first hour, I should have mentioned this, but the first hour of the London session can also offer some really good moves as well, directional moves. Really quickly, guys, correlation trading. Professional traders don't tend to look at the euro dollar in isolation. They understand that there's correlations. So let me just go to the chart here. Here we go. I did have something set up for this. So you can do some research for yourself regarding this, but the euro dollar tends to have a strong positive correlation, as you can see here, with the euro pound and the euro yen. Look, I mean, when the US dollar rallies, euro pound, I mean, look, you can see basically that they move, uh, they're highly correlated. Then you have, let me just remove these two. Then you have a very historic inverse correlation with the US dollar Swiss. I mean, look at the correlation here. It's a very strong correlation. When the US dollar Swiss drops, the euro dollar tends to rally. Something I used to do, I still do actually, as a technical analyst, is highlight the key support and resistance levels on both of these charts. So if the US dollar, as you can see in orange, is hitting a resistance, and the euro dollar is also hitting um, an equally important support, this can really add some weight to your trade. If you're either way, if you're entering euro dollar long or dollar Swiss short. We also have yields, which I've already gone over. Gold tends to have a positive correlation with the euro dollar, and this is because they both typically move in the opposite direction of the opposite direction of the US dollar. Since gold is internationally priced in US dollars, a weakening dollar makes gold cheaper for international buyers, so it increases its price. Think about it this way. Look, if the euro dollar jumps from 110 to 120, that's a big jump, but with the same euro, you can now buy more dollars, making gold cheaper in effect. So how do I use these correlations? Look, I'm not a massive fan of correlations, to be honest. I I don't trade in isolation. I'm aware of the correlations. But if you're seeing, for instance, if you're seeing the euro dollar rally, but the euro yen is falling, that's a red flag for me. It means that the euro isn't broadly strengthening. This divergence often precedes a reversal, so just be aware of that. Yeah, so that's something I would watch closely. So finally, technicals. This is where I look for. So once I understand, so we've built our base. We know the central bank's bias. We know the economic data. We know our triggers with the economic data. There's a lot more into how you plan for the economic data, but this is just giving you a broad overview of how you can trade the euro dollar. So central bank bias, understand what the economic data means in terms of that bias. Then look at positioning. Are you overstretched to the long side? Are you overstretched to the downside? Understand this. I will still trade a market based on the central bank's bias and economic data without positioning, but it's nice if you have all the ducks lining up in one place. So you have positioning in place as well. Then I'll look at the technicals. So I want to show this example. I mean, this was just a beautiful example. So I'm a big fan of IQM levels. So these are inverted Quasimodo levels. I've been over this a number of times in different webinars. If you're interested in understanding these support and resistance levels, just do a quick search. They're all over FP Markets YouTube. Quasimodo, I think I did parts one, two, and three for QM support levels. I also look at opening levels. So I look at I will tr opening levels for yearly opening levels. So for instance, when the currency pair starts trading at the year, I ping a line across from that opening level. 6 month levels, so half year levels, same. Look for the open, ping that line across. These are unbelievably good support and resistance levels. I do the same for the quarter, 3 month levels, and monthly. I don't go any lower than the monthly. Some traders I know you use weekly opening levels as well. I tend to find that the yearly, 6 month, 3 month, and monthly levels are perfect. Anyway, back to this. So look, guys, I'm well aware that this is not the euro dollar, but this is a perfect example of how you can trade one currency pair knowing the what the central bank is doing. So, as I said, this is the New Zealand US dollar as an example. We are looking to scalp out of that event. Um, uh, so this week saw the IBNZ stand pat and hold its official cash rate at 2.25%. That wasn't what triggered the sell-off. I believe it was the RBN's decision. Sorry, it was the primary reason for the strong downside in the New Zealand dollar was to do with the central bank's projections showing a shallower tightening cycle because the RBNZ right now, according to the markets, they're expecting to hike rates. So while the Fed is on about potentially easing policy, the RBNZ is looking to hike rates. So there's incredible divergence opportunities right now. So as I said, the primary reason was a shallower tightening cycle compared to what the markets had forecast. So the RBNZ are expecting one rate cut when the markets were expecting two, for example. I can't remember the exact numbers, but that was the nuts and bolts of it. And this prompted a obviously it prompted the markets to pull back on their rate hike expectations. I think let me just check my notes here. I think it was they trimmed year-end hike expectations for the RBNZ. They trimmed these back to 25 basis points. That's one rate cut back from 38 basis points. That's nearly two rate cuts. So there's 50 basis points in a rate cut. So from 38 basis points the day prior to 25 basis points on the back of that. And this is what we saw. So we saw the release, the announcement was at 1 a.m. London time. So as you can see here, let me just zoom in. 1 a.m. London time, a strong move to the downside. Now, for anyone that understands the QMs here, so we have a QM support here. At this point here, this left shoulder here, I look for a defined close below that, below the low of that pattern. I won't go into detail here, but suffice it to say we close below this support here, and then you look for a retest of this. Very basic. You know the macros told you, informed you as to why the currency is dropping. Now you look for when. This is where your technicals come in. You look for when to enter the market. You can look for, you see we hit a low of 60.12, and then we printed a mild pullback, and this is where you could have entered short. Look, even if you're a candlestick trader, you could have gone on the back of that bearish pin bar, that terrible looking bearish pin bar, or shooting star if you're into Japanese candlestick patterns. There, you could have entered short at this point here with your stop wherever you look, 20 pips or whatever. And then you could have looked to even pyramided your position. Pyramid means adding to your positions on the back of the same setup here, guys. Exact same setup. We break below this QM support here. We break below, and then we retest the underside of this level for a nice shorting opportunity. Unbelievable opportunity here. But as I said, guys, this is 1 a.m. my time. So, but you can see here, the RBNZ, it's complete surprise here. And this is what moves markets. Complete surprise. Markets were pricing in a higher tightening cycle. So, for instance, they were looking at 2 rate cuts this year. The RBNZ comes out and says, no, we're probably only looking at one. Yeah, that was a complete surprise to the market. And now they're thinking, wow, we have to readjust our positions. We have to readjust our expectations for rate hikes. And this is the reaction. You see the New Zealand dollar, because the New Zealand dollar would sell off on the back of that. It's a very simple trade if you're paying attention. Okay, so a quick recap, I believe, is the next slide. So a quick recap of what drives the euro dollar. The euro dollar is a liquid and trader is a trader liquid is liquid and tradable. It's highly liquid. There's a ton of willing buyers and willing sellers there, and it's very easy to trade in terms of getting into a position and out of a position. It's driven by a number of factors. Sorry, interest rate differentials, economic data, and risk sentiment. Key to understand. Session timing positioning is also very key. I should have added that on the slide. Session timing matters. I tend to trade around London and New York because of where I'm based here in England. And as you can see here, traders do use correlation analysis to confirm the directional bias. So if the euro is broadly strengthening, you can see this with euro correlations, and this can be used. I don't personally use it much, but I know of a number of traders that do use that. Now, finally, look, a winning mindset. I didn't pick this picture, by the way, guys, so just bear that in mind. The winning mindset. So, look, I've seen traders. This is very important, something that's incredibly overlooked by a number of traders. I've seen traders with mediocre strategies make money consistently, and traders that with excellent strategies, with excellent market knowledge, blow up their accounts. The difference for me is their trading mindset. So the market doesn't care about your emotions, guys. It really doesn't. It doesn't care about your bills. It doesn't care about your well-being. It doesn't care. It doesn't, or your need to win. It simply moves based on supply and demand. It moves where the bids are. It moves to where the bids are. It moves to where the offers are. Your job as a successful trader is to execute your plan with machine-like consistency, if you will. Process over outcome. So look, you've got to stop obsessing over individual wins and losses. Focus on executing your process correctly. Look, I would say a bad mindset is um, someone that says, I need to make $500 today. Look, a pro mindset will wait for their setup and execute their plan flawlessly, regardless of the outcome. Wins and losses will occur. My mentor always told me this that you need to become a master of being wrong in your trading, because you will be wrong, and you need to become a master of accepting that you will lose money on some trades. Now, this is easy to pay lip service to, but it's very, very difficult to do in reality when you have money on the line. So being wrong and losing money is like a double whammy of pain for a lot of traders. And this is where you need to build slowly. Start with one currency pair, start with a small trading account, and build your familiarity to risk. So risk only a small amount. If you can trade that consistently, you build on that. It always makes me laugh when you take a week course or something like that, and you think you can trade with professionals. That's like going to university to study to become a lawyer for a month. It just doesn't work like that. Um, so you don't control whether a trade wins or loses. You only control whether you can follow your rules. Now, your rules should have been back tested. You should have forward tested your rules. You should be aware of what the data is. You should be aware of how many losses on average you should get. So it shouldn't be a shock when it happens in real time. Trading is a probability business. Even a setup with 70% win rate loses 30% of the time, guys. That's normal. Three losses in a row doesn't mean your trading strategy is broken. It might be just variance. Keep a trading journal, guys. Track your trades. Note your weaknesses. Note your strengths. And only after you have a decent sample set of trades, only then can you know if your edge is real. Never become emotionally attached. I mean, this is pretty much self-explanatory, I would think. If you become emotionally attached to a trade, you've lost your edge, in my opinion. You've lost your edge. You're essentially gambling, in my opinion. Practical techniques to consider if you're just starting out, risk only amounts of money you can afford to lose comfortably. This is why I said start small. There is no need to start with a huge account if you're just beginning your journey. Um, Depending on your strategy, use alerts instead of watching every candle. This can be very dangerous for a new trader. Set your stop, set your target, and then step away. Um, Again, this depends on how you trade. If you trade like me and you trade out of risk events, you need to kind of be at the screen and watch. Never, guys, this self-explanatory. Never average down. Never average down on a losing position. Do not add to your losing positions. This is not a good way to trade. Um, Amateur traders take 10 mediocre trades, right? Pro traders, they take two or three fantastic setups, high probability setups. Some days there are no good setups. That's fine. Trade flat. That's a trade in and of itself. No trade is a position. That's what I meant to say. So I've had weeks where I only took two trades. That's fine. As long if your setup doesn't appear and your macro bias doesn't align with your technical bias, then you don't trade. It's as simple as that. Review, review, review. And this really comes back to your trading journal, guys. Every week, every month, review your trades. What did I do well? What mistakes did I make? What patterns am I seeing? How can I refine my edge? The best traders are constantly evolving and they note their findings in a dedicated trading journal. So common mistakes I see traders make, and they're really quite painful um, to experience. Revenge trading is number one. You take a loss and immediately jump in another trade to try and make your money back. Rarely does this work, and it can create a very vicious cycle where you keep doing it. This is emotional. This is not strategic. Take a break after a loss. It's as simple as that. You've had one loss. It's a loss among many trades. It's as simple as that. FOMO, fear of missing out. You see price running and you jump in without your setup. Why you would do this, I don't know. You're not following your plan. You're not a professional trader if you're doing things like that. This is chasing. You should never chase a trade. Wait for your edge to materialize and then trade. It's as simple as that. Overconfidence after wins. This is something I experienced quite a bit in my earlier days. So you have three winning trades, and all of a sudden you think you're God's gift the market and you're risking 5% when you should only be risking 1%, because you can't lose, right? Stay humble, stick to your rules. Analysis paralysis is another one. You have the setup, all filters confirm, but you can't pull the trigger because you're afraid. Uh, this is a fear of loss. Remember, not taking your valid setup is also a mistake. So do bear that in mind. The moving stop losses, I'm pretty sure all of us have done this. For anyone that's traded, I certainly have, and I've experienced huge losses on the back of this. Price approaches your stop and you move it further away, and you're hoping for price to turn higher. This destroys accounts because when price continues to head for your stop, you then move it again, and you don't realize the loss you're accumulating on the back of that. Set your stop based on market structure, based on your technical expertise, and never move it against you. You've set your stop. You set your stop when you was unemotional. So you was before you was even in your trade, you decided on where your stop was. So what makes you think when you're emotional, when you're emotionally charged in a trade, you think you're going to be better at judging where to place your stop? It's just not going to happen. So do bear that in mind. So a mindset checklist, if you will. Um, Look at, is this my setup or am I forcing it? Does this pass all of my filters? Is the macro bias in aligned with my technical bias? If it is, great. Is my risk to reward at least 1 to 2? So you really want to be aiming for quite a good risk to reward on your trades. Am I risking only 1 to 2% of my account? Do I have a clear invalidation point? So do I have a clear area where I can place my stop loss orders? Am I emotionally neutral about this trade? If I lose this trade, will it cause me any emotional stress? It shouldn't do because you should work slowly. You should build yourself. It's like training to be. I'll use lawyer again. It's like training to be a lawyer. You can't be expected to understand the industry after a month. It just doesn't work like that. You need to take your time, become familiar with the risk. Because look, as traders, we are risk managers first and foremost. So you need to become f familiar with this risk you are taking because you are risking money every single trade you take. And this is key. Trading is not a marathon, guys. It's trading is a marathon. So, I do apologize. It is a marathon. It's certainly not a sprint. The goal isn't to get rich by Friday. It's it's to develop a sustainable edge and compound returns over the months and years. And this is certainly attainable if you stick to your rules, if you take your time in beginning when you begin your trading career. So that's something I would. So that was really my key takeaways there, guys. Eurodollar fundamentals. Sorry, it's driven by interest rate differentials, economic data, and risk sentiment. London and New York sessions are key. Respect your your technical studies. Understand that you do need to plot solid support and resistance levels. On mindset, as I said, process over outcomes and things like that. Look, one final thought here. The market rewards consistency, discipline, and patience. It really does, in my opinion, it punishes greed, fear, and impulsiveness. I cannot remember where I read this, but your edge isn't just in what you know, it is the ability to execute what you know consistently over hundreds of trades. That was key for me to understand, and it really hit home. All right, guys, if you have any questions that I don't see any questions in the chat box as of yet. I did have a couple of traders send me some questions to answer live because they'll be watching the recording, so we'll go over them if there's none. If you have any follow-up questions or future topic suggestions, please do forward them to market analyst at fpmarkets.com. We do have a dedicated academy, which we are currently updating. So please do visit the academy. There will be a link. We'll try and put a link in the chat box um, regarding that. So I had one Look, a very common question. This is look, if I had a pound for every time someone asked me what the best time frame to trade is, I'd be a millionaire. So, what is the best time frame to trade the euro dollar? For me, given that I scalp risk events. It's the 5 minute chart for me. I don't need anything really else. I just need to know where I am. But look, I do know where my daily levels are. I do know where the daily support and resistance levels are. So I know if I'm shorting a market, but I'm shorting right into a daily support, what do you think is going to happen? It can potentially rebound on me. It can potentially be a short-lived move. So I'm well aware of that. So primarily, I look at the 5 minute chart. And but it all depends on your lifestyle and your trading style. We have four trading styles, guys: scalpers, day traders, swing traders, position traders. They're all different time frames, guys. So you really need to understand that, and then you can answer that question yourself. Another question I got from one of our clients was, how much capital do I need to start trading euro dollar? Look, you can open an account with as little as 100 US dollars with FP. So, but look, for me, I would always start with a demo account, then build up very slowly. So, $100 is a bit too, is not enough, in my opinion. It needs to be small enough that it won't hurt too much, but big enough to make you focus, to keep you focused. So I would say 1,000 US dollars comfortably, 1,000 to 2,000 US dollars to trade comfortably. And then once you start showing consistency with that amount, so you're only risking $10 per trade. Um, and then once you become familiar with that, then you can build your account up. You can build it to 5,000. You can add some money and add on to the returns you already have, and then you build that way. Um, a term, systematic desensitization. It's where you gradually do something and you become more familiar with it. So, for instance, if you're scared of spiders, the way to reduce that fear is to be around spiders more often. Easier said than done, I know, but it's the same with trading. The only way to become more familiar with the risk is to become is to trade, is to have some skin in the game. So, but start small, build your way up. Um, Another one was, should I use stop losses? Yes. For me, always use hard stop losses. It's non-negotiable. Some traders I know that don't, and they're very successful. But for me, one trade can ruin you if you don't use stops. So yeah. One other question I had is, what indicators do I use? I've pretty much answered that in this webinar. I don't use any indicators really anymore, but I'm aware of most of them. But if you're familiar with price action and you know how to read price action, this is all you need, in my opinion. One final question I had was, how do you deal with losing streaks? Look, guys, losing streaks they can be very detrimental to not only your financial situation, but also your psyche, right? But the only way I've found is through systematic desensitization. You build your way up slowly. So if, for instance, if anyone's watching right now and they're pretty new in their trading journey and I don't know what your financial situation is like, but if you've added a huge amount of money to your trading account and you think you're going to be able to trade that in a consistent basis, I would really think carefully about what you're doing here, because you've essentially just gone um, from beginners right to advanced if you've done that, because you're going to be trading quite a serious amount of money, and this is not the way to approach trading in a professional manner. Start small. The reason how I deal with losing streaks is simply this: I build slowly and I gather the data. So if I have 100 trades under my belt, I know from that data, I know that I can have potentially five losses in a row. I know that that can happen. So if that happens, a losing streak, five losses or four losses, I don't panic because I've seen it before. I know through my back testing, through my forward testing, I know that that can happen. So that's why preparation, that's why you should take this slowly. I know it's so tempting to jump in. You think you know what you're doing in terms of your analytics. You may well do, but the psychological side of trading is incredibly incredibly important. Uh, One other question I got. Um, can you make a living trading the euro dollar? Look, I believe you can. I genuinely believe you can. And if you look at the banks, the investment banks, they specialize. They specialize in the euro. They specialize in the euro dollar. So you have professionals that know everything there is to know about the eurozone economy, the US economy. So I believe you can. Yes. Do I look at other currency pairs? I do. Look at the RBNZ right now. I follow the New Zealand dollar closely, and also follow the RBA, the Australian dollar closely. But that's over time. Start with the euro dollar. Work slowly. Work your way up. And that's all the questions I have there, guys. I think. All right. So, look, thank you very much for your time today. Again, guys, trading is a journey, it's not a destination. Stay disciplined, stay patient, and focus on continuous improvement. Thank you very much for taking the time to be with me today. I hope you're um, leaving with leaving as a more informed trader than you when you joined. Happy trading, and I hope to see you in the next session. Thank you very much.